Okay, testing, 1, 2, 3, testing, 1, 2, 3. The Wayne in Spain falls mainly on the plains. Ziensen France de Melin Japans. So, Ohio, Guten Morgen, Jumbo. Three, two, one, hit it! Two trailer park girls around the outside, around the outside, around the outside. I better be careful. I might be copyright slapped. I gotta be careful. Not even allowed to sing songs anymore. So anyways, hey, good morning, everybody. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please stay small, stay humble. Focus on the long term and never risk money you cannot afford to lose. So g'day, mate. How are you? Oh, your mum? My name's Wayne McDonald. I'm a currency trader. I like currency trading. It's very interesting. In the last week, I've been studying forms of private equity, which is venture capital, growth equity, private equity, buyouts. So that's what I still think what we do is so much better than what a leverage buyout firm does, or what a growth equity firm does, or a venture capital firm. Like, this is so, oh my God, we're liquid. We get instant results. Oh my goodness, right? Oh my goodness. And private equity. Oh yeah, they can leverage up. Yeah, what, to 4 to 1? So anyways, so what we do is the best I've ever seen, the best there ever will be, most likely. So I'm very happy to be a Forex trader, and I've been doing that for 20 years. Yeah, cool. So nice to have you here at the Forex.Today YouTube community, which is now more than 16,000 foreign exchange traders. Now think about that. We're getting to like a small rock concert. That's pretty good, considering how many Forex traders there are. That's actually pretty amazing. We are, being a Forex trader is somewhat of a boutique service, right? There's not a lot of us. So to think about that we have 16,000 retail traders, maybe a few professionals out there that are tracking this. Our community, I think, is pretty exciting and something to be proud about, I guess. By the way, I don't consider pride a deadly sin. So anyways, no, but I don't say, for like Henry says, like, congratulations. Yeah, well, actually, I don't mean to me. Honestly, I never even thought about it that way. I mean, to us. I mean, it's just cool, but other than that, right on, right? Like, cool. So, very interesting. I think it's just showing that we're doing a good job. And I honestly, truly mean we, not me. Like, I think we're doing a good job as a community. And it provides maybe hope and knowledge and education and entertainment. But out of that, a very small few take the next step, and maybe they join FX Bootcamp, and then they take the next step. They join one of my live groups, and they take the next step, and they move toward professionalism. And I think that's cool, right? We can save a few Forex trading souls. So very nice. So thank you for being here. Thank you for your professionalism and dedication. Most of you guys are at the charts, ready to go for this webinar before I've even hit the launch button. So I appreciate that dedication. And remember, I think the two most important things or characteristics of really almost anybody, but in particular Forex traders, is you have to have half of a brain, at least. You can't be an idiot. But you don't have to be a genius either. You have to have at least half a brain. But you do have to have a ridiculous, sickening work ethic. So when there's like people waiting to get to work, I think that shows the sign of a ridiculous, sickening work ethic. So thank you for that. So right on. The Trader's Way is the sponsor of our community. I thank you, Trader's Way. We appreciate you. We're a community of Forex traders. So, hey, we need an execution partner for our successful Forex trading businesses. So we need a broker that actually executes trades, actually executes them in the interbanking system, and executes those trades into the interbanking system as fast as possible. We're not talking seconds, we're talking milliseconds. And then, of course, fees and costs have to be also competitive, right? So spreads seem to be narrow, swaps seem to be big, and if you have an ECN account, right now fees are half price because of the COVID crisis. So thank you very much, Trader's Way. They exhibit the characteristics I think are important when choosing the prime broker to your successful Forex trading business. So if you're going to treat your trading as a business, then you are going to need execution partners. So tradersway.com. Open up a demo just even out of a sign of loyalty and respect. Okay? And then allow them to earn your loyalty and respect. So please. Okie dokie now. Okie dokie. Let's get going. What would you like me to cover? What's on your mind? Now, I think one of the important things is what, everything we're going to talk about today. Let's put it this way. So what day is it? It's a Tuesday, isn't it? No, my God, it's Wednesday. Honestly. What a life we lead. Okay, so it's Wednesday. Okay. Everything we're going to talk about today was likely discussed on Friday. Now think about that, because we didn't know what Wednesday was going to be like on Friday, but we did analysis, right? Which would lead us to where we are now. So what we talked about now is really, that's Friday's info. Maybe Monday, but I doubt it. Like, I can't remember the last time there was a Monday where you show up and you're like, oh, that's what's happening. I can't even remember the last time that happened. So like, this is just, you either got knocked out of your trades because it didn't go in the direction of your bias, or you're profitable right now because it did go in the direction of your bias. So like, Wednesday often is take profit day. If not that's a little early. But Thursday is typically a take profit day, right? Here's his Wednesday front runs. Well, I prefer to wait till Thursday, but I can tell you there are definitely Wednesday front runs. I'm assuming you're talking about weekly swings. But in New York, you're very often trading tomorrow's trades. Mahir says it's been risk off all week. I know, but that's what we talked about on Friday. All right, so let's go. Let's do a quick around the world. Aussie's weak, Euro's weak, CAD is weak, Pound is weak, Kiwi is weak, Swissy, dollar, yen are all strong. That is risk off. Sure, Yar says, hey, man, it's COVID, right, Mahir? Yeah, but I was laughing about that on Monday, because that's what the media says, but I was already short. And it had nothing to do with COVID at that time. It was short because it was supposed to be short. It was supposed to fall. So what I said on Monday is you got to be careful, because when people show up and they see the stock market drops 1,000 points, they look around and they're like, well, what happened today? Oh, the COVID numbers spiked. It must be the COVID numbers. But you got to be very careful, okay? If you eat a lot of ice cream, let's say you buy a bucket of ice cream, right? 5-liter bucket of ice cream, and you eat all of the ice cream right here, right now. You just start plowing in with a big fat spoon. Are you going to make the temperature go up outside? Is it going to become a hot, sunny summer day because you've eaten a lot of ice cream? But we know for a fact when ice cream sales go up, it gets hot outside. Is that true? We know it. You can track it. I can show you the stats. I'm sure I could Google it. When ice cream sales go up, it gets hot outside. Is that true? The statistics will show you. Right, so sure, yes, yeah, change the answer, which is good actually, right? So yeah, there was something else happening last week, and really all month. I mean, it kind of fits into what we're doing, but we got to be careful because this is the media telling you these things. But it isn't necessarily wrong, but it isn't necessarily true either. So what turns out, by the way, on hot summer days, people tend to eat more ice cream. But ice cream doesn't make hot summer days. So the market fell on Monday, and we don't know for sure. Like, I can't say, oh, I know and everybody else doesn't know. But what I'm saying is they could be two completely independent variables. Could you agree with that that's one possibility? That the stock market fell and COVID-19 cases reported higher, and they may not actually be related. In fact, there could be 5 other things that happened that day as well, like no stimulus or a new Supreme Court justice, but I didn't read anything about that. It could have been one of those things. But all I'm saying is we don't know, okay? And the media tells you they do know, and they might be partially right, completely right, or completely wrong. But the interesting thing is, 72 hours before the Bloomberg told me what was happening, I was already short because that's what it was supposed to do. So, different look at the variables, right? So we could revisit it. Let's get rid of this. That's the old long. Okay. All right. So where were we on Friday? On Friday, let me get my drawing tool. Oh, it's over there. I see it. Okay. Let's rediscuss what we did Friday. Okay. We said this is an exit. Okay. And if you were a bear, I lined this all up. I drew all the prices. And in fact, you see this upper bound here? That actually didn't exist at that time. Because when we talked about it, I think we were still sort of in this zone. Okay? This is the close of New York. We get together at the beginning of New York. So it hadn't quite happened yet. So this pivot was a little lower. It was more like here. And this pivot was right here. There's also the midpoint strike level of 1.1850. Okay, we call that a midpoint. Okay, and if you remember, I drew it this way. I said down. I had an arrow. Do you remember that? And I said no stimulus. Okay, do you guys remember this? And then I had another arrow right here, and it said stimulus. Okay, you guys remember that? Stimulus, no stimulus. On Friday. So On says, so why did you short? Well, first of all, this is an exit, so this tells me bears are out. Okay? But here's the biggest determination. Okay, you listening on? Timing is everything. And we cover this a lot in the swing trading group. Okay? This is the first hour of the week, And that is not a buy. That's a sell. Sold. That's it. That's it. It's not a buy. 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 Okay? The best thing you could do in this situation would to have waited for a retracement down into the 21, but that didn't even happen. So there was never a buy. But there was a clear sell. Okay? And again, if you're not in the swing trading group, well, I mean, you just don't know these things, so I'm sorry. But we talked about the meaning of this pattern in this situation. Okay. And yeah, I mean, that's that. I mean, again, over the weekend, if it was announced there was an election before Senate broke, then boom. Okay, then, I mean, if there was a stimulus announced over the weekend before the Senate broke, then yeah, on Monday I would have been buying just because of the fundamental change. But technically, this was always set up. If you go back to Friday, we had it all set up that way. And stimulus wasn't likely, and then it didn't happen. I mean, I don't know. Like I said again on Monday, of course, it's bearish, bro. There's no other way of saying it. What, you didn't get a stimulus package, so you wanted to be risk on? It doesn't make any sense, right? Plus, we're already conservative. But if you recall, I drew it all out, and I said we're coming back down to here, right? Remember? I think I had something like this. I don't really think it's going to go lower than this. So I have about, 25 more pips before my profit taking? Could happen today, could happen tomorrow. Oh, Mahir says, yeah, I think we talked about it on Thursday even. That's right. That was the other big thing. Thank you, Mahir. We talked about that on Wednesday, that this tells me double top. Thank you for pointing that out. That's key. That's absolutely key, Mahir. Thank you. Okay? That tells me double top. And if you don't believe me, I wrote a book 15 years ago or whatever it's been now, and I put it on paper. I also did a training course and then another training course. And I spoke at 30 different conferences around the world to explain this concept. And oh my God, I was right. Thank you. Also, the other interesting thing that I did, and we talked about this, I think, yesterday, which was Tuesday, I was buying the dollar against the euro, but I was selling the dollar against the Aussie. Both were profitable. Both had stops jammed at break even. And I said, one of them's going to make a lot of money, and the other one's not going to make any money. I don't even care which way the dollar goes anymore. And that's interesting, right? Manuel says, you said potential lower high. Let's see. Higher low, lower high, lower high. Yeah, well, that's what that means. That's the same thing. A double, to me, this is the same. Like if you say, well, that's a lower high, that's a double top. It's the same thing. You're right, I'm right. It's a double top, it's a lower high, or a higher low, or whatever. Yeah, I don't care. Like, I don't get caught up in all these patterns. Some people are like, oh my God, there's a huge difference between a triple bottom, right? A head and shoulders, or a crown pattern. You know what? To me, it's all the same damn thing. I don't care. You either bought it at support or you didn't. And the only way to know before it happened is you were already a bull. I mean, like, I really don't care. And some guys will go on and on and on about hours like, oh, no, this means your uncle drinks too much, and this means your garbage is gone and your dog's pregnant. And I'm like, no, it just means if it's support and you're bullish, you should probably be looking to buy. Last week's lows. Yeah, this is all I'm talking about. And I said this. I mean, I swear I said all this, right? I'm 117 is good enough for me. It's not a trend trade. We're positioning for a trend trade. You guys know my fundamental bias and my opinion. The dollar will weaken between now and January 1st. It may not be a good buy today. It may not be a good buy this week. And we kind of saw, we saw the signs, right? Just like, what band was that? Roxette. Just like Roxette. I saw the sign and it opened up my eyes. I saw the sign. Right? Oh my God. Right? So you're like, well, okay. Bears have their turn. One way I described it was, look, bears had their turn. Look, perfectly bearish. Perfect bearish trade. Perfect bullish trade. Perfect bearish trade. Nothing's happening. Okay, so I can give up on my fundamental trade because I can see it ain't going to happen. So whatever. So one of the things, again, let's go back with my live swing trading group at FX Bootcamp. We talked, 3 weeks ago about how to handle this situation, being caught between your long-term fundamentals and your short-term technicals. Oh, is it Ace of Base? What did I say? Roxette? Oh, yeah, sorry. Ace of Base. Yeah. Yeah. Wait, it's not Roxette. Honestly, if I was hanging out in a bar, and I think they're both from Sweden, aren't they? I'm hanging out in a Swedish bar, and on my left is Roxette, and on my right is Ace of Base. I couldn't tell you which is which. It reminds me of one time I was at a party, and I had a German friend talking to a Dutch friend, and I walk up there, and they're talking and having sort of a deep conversation, and I walk right up and I interrupt them, and I'm like, to me, the Dutch always sounded like drunk Germans. And they were both insulted. And that's sort of the same thing, like, Roxette, Ace of Base. Huh. Yeah, interchangeable, like, right? One's a Barbie and anyways. Anyways, the signs are there. I saw the signs and it opened up my eyes. So how to handle long-term fundamentals not green with your short-term technicals? We deal with that in the live group. Okay. We deal with that because the people in the live group know how to trade and they know how to trade profitably. So we have to work on other things besides, look, this is how you should short. Look, this is where you should buy. They already know all of that. All right, cool. Okay. This was the old bullish point of view. If you remember, I was short euro long this, and I said one of them's going to make money and the other one won't lose money. This is the one that knocked me out at break even. I had a chance. I had a shot. You can see I have it set up to be range bound. So I'm not even really expecting it. I just had the opportunity. So there was a double bottom, which you could have traded, then the higher high, which you don't trade, then the higher low, which I did trade, and now I got knocked out for -3. Right? And that's that. Love it because it lowers my average loss and makes my winners look big. Okay? Cool. Good loss. Nice loss, dude. Seriously, that was an epic loser. Fantastic. Okay? That's how you lose, Bubba. Okay? So there's lots of signs that this ain't going to work. Okay? What does that have to do with anything? Are you a bull? Yes. Are we at support? Yes. Did you get a pattern? Did you get the opportunity? Yes. Did you trade the opportunity? I hope so. Are you looking for 100% winners? No, I'm not. Okay? This was plausible. This was potential. You got it? There is potential energy there. We just don't know the level of kinetic energy. So you take a shot. I took a shot. And I was already short euro dollar at break even, so I took a shot here, moved that to break even because it's still a good trade. Look, it was up for 2 days. I was profitable for 4 days, brah. Okay? Not very much, honestly, like 20 pips or something. So one of them was going to win. One of them was going to make me 100 pips, and the other one was not going to lose money. Oh, I'll do that all day, every day, right? And it knocked me out. So what? I had a shot at the net. Take a shot. Take a shot. Can't score. Okay? Yeah, did my job. Ready, willing, and able. And that was my job. It was a good entry, but right? The other thing is, you still have to trade properly. You still have to trade right. You have to look at this at monthly, weekly, daily. You got to know what your fundamental bias is. You need to know the market conditions, the news on the calendar. All these things are important. Okay, cool. That's all. Right on. So if you're like in if you're in Brexit mode, you'd be selling this, right? If you're in Brexit mode, you'd be selling this. But that's not like, that's all set up for bearish, right? Or bullish, right? So let's look at bearish. Can you see that? What we're saying here is in the month of September, you want to sell around here. So if you're already a bear, at what point do you get on the clue train? Here? 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 Okay. When do you get on the clue train? Well, you can see you're going to get on the clue train a lot sooner if you're already a bear. And you're like, well, how do I determine that, Wayne? You make a decision. You do research and fundamental analysis, and you say, with Brexit, there's a lot of risk in the British economy, and that's not going to be favorable. Okay. Or you're just like, I think the pandemic in the United States is pretty bad, and it's going to get worse, and it's going to be risk off. You could even be wrong, and you're like, well, I think Trump's going to win, so the dollar's going to get strong. Okay, whatever. You could even be wrong. Nobody even cares. Whether you're right or wrong is not at the end of the day, but at the end of the year, whether you're right or wrong in your bias is actually irrelevant. Okay? If you're wrong, you'll still be profitable. Probably more profitable than you are now. Even if you're wrong on your bias, you will be profitable at the end of the year. If you're right on your bias, you'll be more profitable at the end of the year. So one gets you a yellow Honda Accord and the other one gets you a yellow Lamborghini. But you ain't starving because you're fundamentally wrong. Because you're still, if your bias is down, you're still only going to sell setups that are bearish. And if you're wrong in your bias, you're not going to get that many because it's bullish, bro. But you're still going to get them and you're still going to trade them. But if you walk around like this, like, what's up, fellas? What are we doing today? Dude, you're already bankrupt and you don't even know it. But the problem is, if you don't put in the work and you're not willing to do the work and you're not willing to make the sacrifices, you probably showed up broke anyways. So nothing ventured, nothing gained. And by the way, the research shows when you don't have any money, you'll risk it all. And that's the problem. That's what's holding you back. You can't be in this game if you're willing to risk it all. You're not going to be a successful Forex trader if you're going big. It won't happen. You're not even thinking properly, and that's the bigger issue, right? So going back to this, if you make a decision, I don't even care why, and you could be wrong. And like I said, if you can't make the decision, you will be better off flipping a coin. And you're like, okay, I'm a bear. I don't know why. I don't know anything about pound. I don't know anything about dollar, but I'm a bear because I flipped a coin 6 months ago. Cool. So check this out. Once you're down in here, you're in selling mode. Went up. Now imagine this. End of September, into October, wait, sell. Okay, you were right for a week, then something happened here. But these are the two most important zones. You want to sell at 130, and you want to sell at 132. So if it goes up there to 131.80 and then drops like a ton of bricks, like, dude, when do you get on the clue train? If the only thing you do is sell this, you're like, oh, this is interesting. Okay, and then it didn't work out, and then what? You're still ready, willing, and able, or what? Do you look at this and go, I'm a bull now? You're broke. That's what happens. Maybe not financially, but you don't have the discipline. And it's because you're not doing the research. And so you haven't made an emotional decision. You're not attached to the pound dollar. You're just trading it like it's another part of the video game. You're just going there, boo, 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 right? Like, dude, seriously, why did you sell this? Because there's lots of green candles. No. And many of you have already tried that strategy, and you already know it doesn't work. So what we do know is you plan your trades in advance, and you feel confident and capable of carrying out your strategies because you did the work, you did the research, you did the planning. And so you're like, for the month of October, you're going to sell around 130 or 132. And now, on all time frames, from 1 minute to 5 minute to 15 minute to hour to 4 hour, whatever, you are looking for technical entries that tell you sell. Right? You see what I mean? If you are dead set, and I taught you this with excruciating detail yesterday. I can either sell or I cannot sell. How many people here got that message yesterday? I don't remember what we're talking about. I think peso or ZAR or something like that. But I'm like, it's 100% fact. I will either sell today or I won't sell today. I will sell tomorrow or I won't sell tomorrow. I will sell next week or I won't sell next week. I will sell next month or I won't sell next month. But I will sell when I get bearish opportunities, and I will not even consider the possibility of buying. It doesn't exist. The button doesn't live on my chart for buying. Okay? So, imagine you lived in that world now on a 15-minute chart. Okay? Because this is a week, and this is a week, and this is another week, and then this is the last week, right? Do you think on 15-minute chart you would have found bearish trades in here, knowing that it's already dropped back into the bearish monthly sell zone? What about the week, right? The weekly sell zone. What about the next week? I mean, you're only looking to sell, and you're selling everything that looks similar to that. Sell. Would you have found any of these in here? I think so. On a 15-minute chart. I'm not even looking at these ones. Right? Well, Wayne, it only did this. You know what? That's not true. It did this. It went down, up, down, You might have had 20 trades in that, right? But the thing is, this whole period, you're ready, willing, and able. You can only sell, and you sell highs. You know how to sell. You could use pivot points, weekly pivot points, monthly pivot points, daily pivot points. You could use Fibonacci. You can use moving average crossovers. You can use price action. You can use anything you want. It doesn't matter. The only thing that matters is your alpha. Your ability, I'll describe it here, your ability to understand that you're a bear in this zone and your capability of carrying it out. Your alpha is not your winning percentage, and your alpha is not your profit. How do you measure alpha, by the way? FX Noob, we're not talking about my alpha, my decision. I'm just picking one. To me, I can trade anything you want. I just have to pick a direction and I'm done. So we're not talking about me in particular. I'm talking about, like Brexit, I would always be bear on pound on Brexit, but there are times when pound recovers like crazy because it's so oversold. Okay? Okay, profit is not alpha. One way to look at it is maybe profit over volatility. Okay? It's actually return over volatility, but okay. So what does this mean? What does that mean, guys? What can we use? Okay, what tool can we use to measure your return over your account's volatility? Did you know? Volatility. It's not spelled right, but I apologize. Okay, because I'm thinking 5 things ahead here. Professional investors will look at this. Okay? This is your alpha. Okay? What's another way of looking at that? What's another way? What besides calling it alpha? What's another thing we could call this? By the way, this is the most important statistic. I don't give a crap what your winning statistic is. Oh, well, 98% of my trades are a loser. No, your trading is a loser. What you just told me, if you told me you have a 98% winning ratio, 98% of your trades are winners, you just told me you don't know how to take a loss. And that is the most important thing. So if you don't know how to take a loss, you're fired. I'm not interested in investing. Disappear. Okay? Is that clear? So right? Or the other way is, like, why isn't, like, what if it said you make 150% a year? Why is that not enough information? You're like, that's good, right? It depends on a couple of things, okay? One is well, let's go to this. If you are down 50% so that you can be up 50% or up 150%, I call this a pain to gain ratio. And the problem with this is you're too volatile. I don't want you to have my trading account down 50%. And by the way, for the math to work, you had to have excessive leverage to get from here to here. And by the way, so risk-adjusted performance says if your return is high, like 150%, and you got it because of leverage, which is risk, then your risk-adjusted performance is actually quite bad. Okay? And you don't want that. So people don't want the leverage. I mean, again, if you're taking 100% leverage and you're making 22%, it's just not cool. You're not doing well. But going back to this, your return, so that's the first thing they're asking you is how did you get your return? So they'll look at alpha versus beta. Okay? So let's say, I'll just pick a beta we could all understand. The S&P 500 is up 9% this year. And you made 90% return this year. How did you do it? Market moved 9%. You made 90%. How did you do it? Leverage. So there's a certain leverage that is tolerable or desirable. And if you don't go, if you don't have big drawdowns, it'll be more tolerable. If you were if the month earlier you were plus 30% and then at the end you were plus 90, you could have easily gone to zero as much as you went to plus 90. And that could be a random occurrence based on when you tested. And that's risk. Again, that's going to be volatility. If the investor doesn't know if you're going to be break even or produce 100%, they're just not interested. Okay, so again, volatility. So leverage is okay if you don't have the volatility of big lows. So if your lowest low was 5% and your highest high was 100%, people are not looking at the 100%. They're looking at the 5% losses. And they're like, well, that ain't bad because there was low volatility. And then, of course, you can tell them, well, don't look at the 100%. Look at that I averaged 5% per month. Okay? And you're like, oh, okay. And you're like, it's actually quite reasonable and achievable, and especially when I'm leveraged. But I'm not crazy leveraged, because if I was crazy leveraged, the volatility would be higher. Okay? So what risk-adjusted tool is common for investors to look at your return, your alpha relative to your beta, and then your return, right? Adjusted for volatility. What statistic do investors use to compare apples with apples? So you produced 50%, I produced 50%. You have more volatility. So let's say your typical loss, let's say, is 10%, and your typical win is 5%. But you might win, let's say, let's say 5 out of 6 months you're up 5%. 1 month you're down 10%. And let's say 5 out of 6 I'm up 5%, and the last 20% I'm -5. But right, and somehow, I don't know if that won't work, right? But anyways, somehow at the end of the year we both produced 50%. I know that's not going to make sense. But let's just say I produced 50%, you produced 50%, and someone's got to make a decision on which one gets the money. And so what they're going to look at is not how much money you're making, okay? They're going to look at the volatility. And in this case, you have more volatility than me, so I'll look better. So now you're getting a ratio. Well, break-even doesn't produce a loss. We're not talking about win ratios. We're talking like percentage loss, like your account going down 10% on your worst month. And my worst month, the account drops by 5%. So your volatility looks like this. You're up, down, up, down, up, right? And mine looks like up, down, up, down, okay? And even if our overall average, so maybe my slope is different. I grow slower, you grow faster, but your drops are bigger, right? So that's probably what it is. Your returns look like this, and my returns look like this. Okay? And at the end of the year, we both end up at 50%. Okay? Which one gets the money? So we use a tool for this. So a risk-adjusted performance is what people look at. This is why I say your winning percentage. I don't think real investors even look at that. The real red flag is when you have a high winning percentage and they're like, oh, this guy's a loser. Doesn't make sense to you if you don't know anything. But if you know something, then it makes sense. Like, people don't want that. People want to know when things go bad, you're going to protect the money. If you are emotionally attached to your winning percentage, you will never take a loss when you're supposed to, because it'll ruin your precious little percentage. People are concerned about their money, bro, not your percentage. Okay? So what we look at is, drum roll, please. Oh, I have a drum roll, don't I? Or is it just not working? Let's see if I can make the baby cry. Yeah, it just doesn't work today. It's weird. These tools are weird. One day they work, the next day they don't. So anyways, drum roll, please. Okay, you ready for this? So you want your return, and it could be anything. Obviously, you want a positive return, not a negative return, because then it doesn't matter, okay? But what you want is low volatility. So we might both make 50% a year, okay? But your Sharpe ratio is 11, and I'm 44, okay? And they're going to choose one over the other, even though we made the same amount of money. Yeah, you can go into Z-scores and stuff. I had to do Z-scores and calculate them by hand as well. Honestly, I don't remember. But Z-score is another apples to apples one, but and there's more than one Sharpe ratio. You know, the Bill Sharpe ratio if you want. But the point is, I'm trying to get you to think that the return isn't the most important thing. How much money you make isn't the most important thing. Okay? It's not your profit. Okay? And it's not your winning percentage. So most amateurs traders that want to trade other people's money, they think if you make a lot of money, investors will invest. No. Then they say, well, if I have a huge winning percentage, like I almost always win, I will attract clients. No. Both of those are fallacies. And it's a paradox, isn't it? But you're going in the wrong direction. So I think the other day I said people are asking the wrong questions, like how to go the speed, how to get a spaceship to move the speed of light so we can go visit stars in another galaxy or another universe or even another solar system. And like, it's the wrong question. You need to be building a warp drive. Different thought process completely. Okay? So you'll have to be prepared for that one day. So I want you to think about it this way. Make a reasonable return. Okay? Rich people are not interested in getting rich quick. They're already rich. Poor people want to get rich quick. Okay? It's a dream. Okay, cool. So you want a reasonable return. So now we're not really, so when you're an absolute return fund like we are, Forex traders, you're not supposed to use a benchmark, but your client doesn't know that, so they use benchmarks. What I mean by that is the S&P 500 is up 9%, right? year over year or year to date. The NASDAQ is up 13%. Might even be 23%. It's not 23, but it's not 13. Let's just change it so it's more reasonable. Okay. Okay. What do you need to make so that customers are willing to give up those investments? What do you need to do to lure them away from, because this is your competition right now. You have to say to somebody like, Billy, instead of investing more money into the S&P 500, give me the money. I'm a Forex trader. How much do you have to produce to be the better investment? Well, these could be considered your discount rate. They could have made the money anyways by giving it to the S&P 500. So if you make 30% in Forex, they're still going to discount it by 15% and say, well, you only really gave me 15% over what I needed to do anyways, right? But Ash is right, like 1.5% compounded, it would beat that. Okay? So like, I'm guessing if you did 2% a month, that's got to be about, what, 33% compounding? Minus the 15 and they're way up. Okay? So yes, so now the next thing they would do is risk-adjusted performance. If NASDAQ was up 15% this year, but was also down 30%, do you understand how volatile it is? So now they're going to do risk-adjusted returns. And even though the NASDAQ's up 15 and the S&P 500 is up, we also know the S&P 500 down was negative 30%. And now it's up, right? Up 9%. So you would do a risk-adjusted performance. How much pain did you have to take before you gained? Cool. And if they looked at you and you had 100% more than the NASDAQ, but you had, let's say, I'll just make up a number, 50% less drawdown, then risk-adjusted is way in your favor. You will provide twice as much money for half as much risk. Now you're in business, son. By the way, it's not the money. It's not the money. It's not the winning ratio. All they're saying is, if I gave you 100K, what's your worst month going to be? And you say, well, my 3-year track record shows my worst month was negative 5%. Now that's pretty good. What if your worst was negative 8? Okay. What if it was negative 10? Okay, these are recoverable. Okay, you can recover from these. If you show negative 20, F you, you're fired. They push you out the window. Okay, they push you off the cliff. You're gone. You're dead. You're out of work. No one will hire you. No one will invest in you. You're dead. As a Forex trader, as a professional money manager, you're dead. You're fired. It's over. It's gone. Goodbye. So, how close to this threshold do you want to get? And by the way, that's not a hard and fast number. It might be negative 15%. And people are like, dude, when I look at your risk-adjusted performance, your numbers are crap. There's just no way. So it's basically the investor's discount rate or risk tolerance, right? So how close to that threshold do you want to get? How close to the event horizon? Like if you hit negative 20, it's over. You get sucked into the star and you're dead. And there's nothing you can do to fix it. Okay? So how close? So maybe it's 10, maybe it's 8, and this is going to be depending on how much risk you are taking. Because remember, if your worst drawdown is -10 and my worst down is -5, it's not that you are a worse trader, but you're probably more leveraged relative to your account size, which means your highest high is going to be higher as well. So maybe my highest high is +10, right? So my pain to gain ratio is, at least the volatility side of the Sharpe ratio is going to be like my worst drawdown is -5, but I usually produce 10, or let's say, but my highest high was 10, right? So now and by the way, if you're thinking about creating an average and then a standard deviation, and you're creating a slope of these returns, +3, +4, +5, +2, +3, -5, and now you're looking at this in an interesting way. But that's the next lesson. If you're doing that, if you're doing returns, you're getting close to your own standard deviation from what your average return is. And then you can say, well, if my average 2.5% a month, why am I up 10% this month? But your clients are going to do this to you. Your sophisticated ones, maybe you're not your first ones, friends, families, and fools, and small people. But when you get institutional, they're going to say, okay, your average is 2, and we're looking at the slope here of your returns. But why is this out here? How did you get this outlier? And then they're going to look at your beta. Because now they're going to do alpha, your ability to generate 10% that month, even though your average is 2.5, and this would be your average, your mean. And so how did you get 10%? And you'll say, well, the period from September to December typically produce higher returns because we have a clear direction into the end of the year. And the stock market was up almost every day. And therefore, the market now, beta is the market. So the market during that month was extremely in the favor, right? Was way up at that point too. So you can say, well, the stock market was up 5% that month. It was just ripper on fire. And I outperformed because I have some leverage. But it was a good month in the markets in general. So we had a systemic rally. The tide came in and rose all ships. And with a little leverage, my alpha was in line with the beta. Okay? If it's not, then it's all leverage and there might be too much leverage. So anyways, so there you go. Your volatility is even more important than your absolute return. Do you understand that? And I've been preaching this for years and years and years and years and years. Your volatility is more important than your absolute return. Yes, you have to be profitable. You can't be a professional trader and not be profitable. You do have to be profitable, but high winning percentages are a red flag because your alpha is going to be based on leverage alone. And leverage is risk, and people don't want risk, so investors will not be interested. And investors are not interested in a high winning percentage because it just tells them that you're emotionally connected to your winning percentage, but not providing a return of value or managing risk. In fact, you won't manage risk to protect something that the investor doesn't give a crap about. So once again, you're like, I have 98% winners. Yeah, not interested, pass. So what is? You have to have a reasonable return in line with market conditions. Alpha has to be in line with beta. And you have to have low volatility in your portfolio, which means your worst month shouldn't be that bad. So how do you do that? You keep your lot size low. You keep your trading focused on analysis and trade plans. And when things are going bad, if you have a long-term point of view and you're having a bad month, you need to pull the plug quickly and protect your month. At least protect your month and just say, oh my God, we're on the 4th day of the month and I'm already down 4%. I need to back out. I need to back out here and reanalyze this. Like, what am I doing wrong? And you start having very serious conversations. Okay? Because you're like, holy crime, right? Holy crapola. I can't go -8 this month. I need to figure out why I'm wrong and tiptoe back in, maybe cut the lot size even further, just so you can start getting into some winning trades, and then you can build on the winning trades versus just throwing down more losers. And you realize this because you have a long-term point of view for your trading. Can you imagine now you're concerned about your Sharpe ratio, not your winning percentage? But isn't that what you're supposed to be doing? You have reasonable returns for market conditions, which means you're not over leveraged, and you have low volatility in your trading portfolio, in your track record. But these are the things you should be focused on. Holy crapola, huh? I'm going to save this. Let's go back in time and save this sucker. Where did I start this? I'm going to save this as a video. That's what happens. Problem is I can't hear it. Hang on, just trying to mark this somewhere. So I wrote alpha at 44. Wish I could play this. Or maybe it is playing, but I don't have my sound up. Hang on, guys. I'm just going to mark this and create a video out of it so you guys can go back and watch the Sharpe ratio. Is my phone connecting to my speaker? Hang on. I can't hear it. Yeah, my phone is blocking the sound, I think. Oh, dang it. I can't hear it. All right, so YouTube is not playing through my speakers for some reason. Come on, you're killing me here. There we go. Okay? If you're wrong, you'll still be profitable. Probably more profitable than you are when you get on the clue train. If you're in Brexit mode, you'd be selling this. And you're selling everything that looks similar. What does that mean, guys? What can we use? Okay, we're closer there. And pound recovers like crazy because it's so oversold. Is not your profit. Anything you want, it doesn't matter. The only thing that matters is your alpha. Oh, there's your ability. You're ready, willing, and able. You can only sell, and you sell highs. You know how to sell. You can use pivot points. What happened? Dude, seriously. Excruciate it. It's 100% fact. And on a 15-minute chart, even looking at these ones, right? And you sell highs. You know how to sell. You can use pivot
Almost
points,
there. Hang on.
weekly pivot points, monthly pivot points, daily pivot points. You can use Fibonacci. You can use moving average crossovers. You can use price action. You can use a. Okay, I'm just going to stop it there. All right, so that's what it is, and then I have to name this. What is risk adjusted performance? Oh, how about this? What do Forex investors look for in a good trader? All right. Let me save this. Hang on. Of course, nothing's working. It won't scroll. Create. All right. So I just created something on the fly. All right. So now there's going to be a video on Forex.Today that will that you can review over and over and over again. It's just focused on that period. Cool, right? Also, let me show you something. YouTube.com/Forex.Today. There's a store now. What? I don't set these prices, by the way. It's just Teespring does all this. The reason I added this is not to make money. The reason I added this is so that YouTube could make money. And I thought maybe if we had a store and people from time to time bought merch, it would tell YouTube people like the community, but also YouTube makes money, right? They make a commission. And I thought maybe YouTube goes, oh my God, we're making commissions on Forex.Today. So let's promote them so we can make more commissions. So really this is help me make money for YouTube. Help YouTube be profitable. So I bought the bunny hug. In Canada, we call them bunny hugs. What do they call them here? Hoodies. Okay. I bought a hoodie for myself and I bought a coffee mug for myself. And they should be here, I don't know, in November sometime. So you will see that I'll try wearing them. Okay. So I thought that was interesting. So we'll see if that helps. Promote us, YouTube. So On says, Wayne, is it better to lose a pip rather than break even? Break even is the dumbest trade you could possibly make. It tells people you're afraid of losing money. It's the worst thing. Okay, and in particular, a trade that you lost a lot of money on and you held on to it because you couldn't take a loss, and then you ride it all the way back to break even. Why wouldn't you try to make money now? You're in the trade. Like, you should always be making money. The worst, dumbest trade you can make is a break-even trade. And then, of course, a lot of people will count that as winner. Actually, now thinking about it out loud, no. The dumbest, worst trade is not break-even. That's the second worst, dumbest trade. The number one worst trade you could possibly make is +1 or +2. Because now you're grabbing one pip and calling it a winner, because now your winning percentage is high. So we just had that conversation. The winning percentage high, you're so locked in to keeping that high that you would consider a 1 or 2 pips as a winner. You're kidding me. Let's say on a mini lot or on a standard lot. Let's say a standard lot. I don't know, mini. I always you risked $100 to make $1. That's what it says. You made 1 pip and you call that a winner. You risked $100 cash for $1. Do you understand like how dumb that is? Oh, but my winners. I have so many winners. Yeah, so you make lots of really bad trades and you make lots of really bad, poor decisions. So yeah, that would be the dumbest trade is a small winner. Okay? The second worst is break even. Oh, I almost lost money. Dude, why are you so afraid? Okay? So when I break even, right? You hear me all the time. I say, oh, my stop's at break even. Oh, my stop's at break even. Do you see this? Is my stop at break even? Like actually at break even? let's see if I can get in there a little bit. I got to turn this off and that off. Oops. Okay. All right, let's go back. La 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 la. This is going to take a while. Oh, there it is. So is my stop actually a break even? Okay. No. No. How about this? Even better. The thing is, I want to be wrong. And by wrong, I mean, has my trade plan failed? Being right and wrong has nothing to do with money. It has everything to do with what your intention was. My intention was this was going to drop to 17. Okay? So if I'm wrong on that, price is going to come up, hit me, and tell me it's wrong. So for me, like this is, it's more than that, but let's say it's negative 3 pips. Okay? The dumbest trade is to get out with 3 pips and call it a winner. Because you're fooling yourself and you're lying to your clients. It's not a winner, bro. You risked $100 to make $3, you're stupid. Don't call it a winner. Oh, well, my winning percent. Nobody cares. Nobody cares about your winning percentage. They want to see you make good returns based on market conditions without too much leverage, and at the same time, have consistent returns in your trading portfolio. That's what they care about. This other nonsense, people care about because they try to be a trader and they get emotional about it. So they realize, well, if I get out with plus 3 pips, the risk goes away, the fear goes away, the pain goes away, and I'll call that a win. Amateur hour. Okay? You're a professional trader. You're supposed to make money. Okay? Cool. So if this, right? If this had popped up, for example, which we knew was a possibility, in particular if the stimulus was announced, okay? If that occurred, I would have lost some money. I'd mark it down on my loser. And then the next time I'm wrong, another loser. 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 And then every once in a while, like, I'm way wrong. Okay? So when you average this out, negative 33 plus negative 3 plus negative 3 plus negative 3 plus negative 3 plus negative 3, right? 36, 39, 42, 45, 48. Okay? So I have I've lost a total of 50 trades, or 48 pips on 1, 2, 3, 4, 5, 6. So divide that by 6. What is my average loss? 8 pips. My average loser is 8 pips. My average loser is 8 pips per trade. How's that for your low volatility? And what if I never, ever, 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 ever take profit for less than 100 pips? I'd rather lose 3, right? But now I have low volatility and high returns. My average loss is negative 8. My average winner is 100. Okay? You see what I mean? Like, I'm focusing on the better statistics. I'm like, well, when I lose 8. When I win 100. Would you like to invest? Okay. Now the other way, if you have all these pissy little winners, now your average winner is 8 and your average loser is 100 because you don't know how to get out. Which one is going to get the money? You lose $100, but you a lot. You very, very often make 8 pips, $8. But when you're wrong, boom, you lose 2 weeks worth of work on one trade. Nobody's interested, bro. MoveOn.com. Right. Time to go back to the used car lot. Okay? You got to focus on the right information. You got to ask yourself the right questions. You got to put yourself in a position to win. Okay? It has to make logical, mathematical sense. Okay? So anyways, yeah, cool. So what do we know? I think I lost 3 pips on a trade today. I lost another 3 pips on a trade today. I'm short at 1850. We're at 1750, so I'm up 100 pips. I have 2 losers and 1 winner. So am I a loser? I have twice as many losses. Am I a loser? I lost 6 pips, but I'm up 100. I win that game every time. Okay? I know how to take a loss. My ratios are fantastic. On today, my average loser is 3 pips. My average winner is 100 pips. Right? Oh my God! Okay? That's what it's all about. Okay? That's what it's all about. Just I want to make sure you're asking the right questions and you're pushing yourself toward the right result. Okay? If you don't know where you're going, then you'll never get anywhere important. What's up, Mitch? G'day, mate. How are ya? All right. Zaran. What? Isn't it amazing this dollar strength, which has nothing to do with Rand, occurs right at the double bottom? Huh. Whale oil B. How many people enjoyed the conversation about whale oil that we had on Sunday at Off the Charts with Wayne? Do you guys want to attend? YouTube.com/FXBoot. YouTube. Does that say it? Boot. YouTube. Oh, I have 2 dots. No wonder. I have this keyboard, and it's so fast. I can't type on it because it's so fast. I bought a gamer computer. Gamer keyboard. and you just look at it, and it goes click, 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 click. I'm like, oh, shit. You just put your hands near it, and the keys go down. It's fast. 2 days ago.
All right, so I like to start with the numbers. And like I've been telling you, it's also a podcast now. You can subscribe to the numbers about being a multimillionaire. Even in his own time, I think he was a millionaire. Which in, what are we talking about, 1830, 1840? Like, that's pretty good money. And then he took the whole thing.
I didn't know the best sound was that bad, guys. You should tell me.
Invested everything in the railroads. Because apparently being a millionaire when everyone else is making $1 a day. So how did Rockefeller become filthy, stinking rich then?
Ooh. There we go.
What was the major thing that changed for him?
He had the ships, didn't he?
Well, he got more into the railroads and had more and more deals with Vanderbilt. That's why Vanderbilt got so rich. So pretty soon it was all Rockefeller moving things, and he would bully his way in and buy more refineries to make more kerosene, because then you would have, better economies of scale, and he controlled that process. But what happened was we went into the Civil War in the 1860s, and the North, what's the word, not confiscated, but the U.S. government seized the oil whaling ships to use as transportation, because they used all the naval ships for the blockade. So they're like, now we need to move stuff around. So they took over all the whaling ships to move cargo and use their supply chain. Commandeered, yeah, that might be the right word. And so all of a sudden there was no kerosene. Well, no, sorry, there was no whale oil. The whaling business went out of business. And then they're like, oh, well, you can use this kerosene. And they're like, really? Can you imagine if suddenly every person in America wants and needs you? It's sort of like the Jeff Bezos of the time, where you're like,
Anyways. Coolio. Sophie says, I've studied so many interesting things. The funny thing is, I'll never forget it. I appreciate everyone's honesty here. When I'm like, I want to write about Gauss, I want to write about Marx, I want to write Locke, I want to write about Ricardo and, the Corn Laws and the rules of rent. And everyone's like, yeah, we don't want to read that. but I still told my wife, I'm like, nobody wants to read the book I want to write. But I still might write the book because I want to write it. So it's just kind of interesting. So all that stuff, right? All that stuff. I want to write about stuff that nobody cares about. But I like geeking out on history and strategy and politics and war and economics. I like to geek out on that. So in that conversation, I talk about Gauss, G-A-U-S. He studied bacteria in petri dishes. And in that conversation on Sunday, I talk about how I would write about trade and political relationships between China and the United States, and how similar examples would be political relationships between England and Germany right before the period of World War I, and also the relationship between the United States and Japan right before World War II. What happened in the petri dish that inevitably led to war? And what did Gauss learn about studying bacterium in petri dishes that would help us be better macroeconomists? And there are rules. He gives very specific rules where the bacterium will kill each other, they'll coexist, or one will dominate over the other. Like, that's what I want to write about. But you're like, but that's Gauss. He's a biologist. Why would we read about a biologist from a long time ago? And why would, as an economist, why would we do that? I don't know his first name. Does anyone know his? Carl Friedrich Gauss. They call him what did Gauss invent? What did Gauss invented? The first electric telegraph. That's not the right Gauss, I don't think. (1777 to 1855). It seems like the right dude. I wouldn't have called him a mathematician, though. Gauss began education at the gymnasium. He didn't get his diploma. It's too smart for that. Zach, an astronomer, who Gauss said, okay, so astronomy was big back then. So when does he do this other stuff? He had a personal tragedy. I don't know what any of this is. Come on. Gauss invented the heliotrope. Interesting. It might be a different Gauss, or maybe I misspelled it. It seems like the right period, though. Non-Euclidean geometry. Oh, that sounds so sexy. So these guys are really interesting, huh? Like their education, 150, 200 years ago, they're still incredibly educated. So then he developed an interest in differential geometry. Yeah, because of the non-Euclidean geometries for punks, right? Very interesting. So when does he get to biology? Maybe it's a different Gauss. This guy looks smart enough to do anything he wants, doesn't he? Terrestrial magnetism. Look at this guy. Hey, we just discovered terrestrial magnetism. Let's write a book. Dude, it's just like, they're so interesting. He showed that there are two poles. Very interesting. So they even figured out the North Pole isn't at the north, or at least the top. Building a primitive telegraph device. Look at these guys, like, let's just build a telephone because they don't exist yet because of magnetism. Very interesting. Two of Gauss's last tutorials. All right, so this isn't the right Gauss, or at least they don't mention anything of his biology. These guys are so ridiculously smart, though, huh? Okay, that might be it, Sophie. When you see anyone named Johann, you're like, all right, this guy's smart. But, like, seriously, like, here's a guy, like, even if this is the wrong Gauss, oh, my God. Like, he's like, oh, I'm going to start in astronomy, and then that's going to lead to creating various tools for that because they didn't exist. And then he's going to go, no, I'm interested in geometry and math. So he's going to do that for 20 years. And then he's going to go like into magnetism. And then he's going to create a telegraph. And like, dude, these guys are freaking smart. And look, do you think this guy has ridiculous, sickening work ethic? How much energy and time do you think he put into research? Like, he probably never got married and had kids. But the funny thing is, back then, you probably did get married and you had 19 children on top of that. But, he didn't spend any time with them. So we got a different Gauss. Maybe I just misspelled it or something. So what did Sophie say? Where's Sophie's comment? Giorgio Fantastic. Gauss, G-A-U-S-E. That's why. G-A-U-S-E. Gauss's law. That seems right. He's got a law, for crying out loud. The net electric flux through a hypothetical closed surface is equal to times the net electric charge within a closed surface. There's our dude, guys. I think. Okay, I don't know. Looks like good. Looks smart. Gauss's law of physics, labor and tax. Anyways, we'll have to look into it. See, the interesting thing is sometimes these guys are known like for, let's say, his work in physics. But then they, like you saw in the other Gauss, he had done like so many other things. So like when we say of Newton, what do you know about Newton? You've been told he discovered gravity. But that's wrong. And if you told him that, like if you could go back in time, like you're Bill and Ted, right? Bill and Ted's Excellent Adventure, and you go back in time, you're like, hey, Sir Isaac Newton. He would be shocked that you're like, what? Gravity. I didn't discover gravity. He'd be the first thing, right? He ripped off Galileo. Galileo was more, put his life on the line to talk about that. So anyways, whatever. I don't know how we get over here, but Newton did so many more interesting things in his life than his pissy little research on gravity, which was just redoing. So he probably read a book on Galileo stuff and then did some research. And they're like, oh, he found it. No, he didn't. Galileo did. But what did Newton actually do? So many more things. For example, he's the one that created calculus in his spare time. Even then, he didn't even report it for something like 10 years because to him it was just sort of boring math. It was just a new math that explained his research, so he had to create calculus to do his research. Then some other dude comes along like 10 years later or whatever it was and said, look, I discovered calculus. And he's like, oh my God, that's my stuff. So he went back and he's like, no, look, I was doing this 10 years ago. I mean, like, in his spare time, in his home office, he busted out calculus. And then, like, he didn't even care enough to publish it and get credit until after someone else was going to take credit for it. So he's like, oh my God, that's bullshit, right? So anyways, these guys are talented and did so much more than, unfortunately, history will share. Everyone in history you think is smart is probably actually 10 times smarter than we give them credit for. Oh, there you go. Competitive exclusion principle. Yeah, but like the other Gauss looks pretty good. Let me pull that up. Where did I go? I have to pull the thing up again. So okay, competitive exclusion, but that's it, right? See, the problem is I don't remember the terms because I studied them years and years and years ago. But it's like if I wrote a book, when I think of China and American trade relations, that's what I think of as Gauss. Which Gauss is it? G-A-U-S-E? G-A-U-S-E? Or is it the other Gauss? Is it this Gauss? G-A-U-S-E? Gauss? Competitive exclusion in... Oh, there it is. There it is. There we go. This is it. So there's rules, guys. So let's say China on its own, the United States on its own, and their GDP. If you don't have the right conditions and the right principles, if you don't handle the situation properly, in this case, one survives and by killing the other. Zero sum. If you change the behavior, the moves, if you think about it in game theory, and this is probably where I studied it, if you change the rules of the game or you change your strategy from one to another, it could end up where one person wins everything and the other one dies. So for example, I look at this one, both species grown together. You could do some research on prisoner dilemma, okay? And when you're in a prisoner dilemma, the most important strategy that you do is defect. Now you'll say all kinds of things like, oh, well, my culture or where I was raised, or I'm not that kind of person. But the bottom line is the math will work out. You're like, oh, you're such a good person. You're going to spend the rest of life in jail, while the other person goes free and gets the bag of money and lives a life of lavish luxury. But if you play the game right, you both will stay in jail for 5 years, not the rest of your life. And then when you get out of jail, you guys can split the money. That's what would, okay? So you both should defect. So this is what's telling me, like, in this case, this is Gauss, and I look at this and I see game theory and I see the math behind it. Oops, and I don't know what the heck that is. Oh, these are the warblers! I brought this up the other day. Oh my God. We talked about the warblers. I had no idea. Look at this. Anyways, cool. So, awesome. Like, there should be a book. Like, you could do this, understand the math behind it, understand the science behind it, and try to predict the rational and irrational behavior and the eventual outcome of trade relations between two countries. By the way, that's what impacts the value of currency between the two countries. Oh my God, someone should put that into a book. Anyways, sorry, I'm way off subject. Sorry. But like, imagine we study Ricardo to understand the real estate market. Okay. Okay. Rob says, can I ask a question? Yeah, absolutely. Sorry, I just got sidetracked. These are things I'm interested in. That's all. Oh, I believe it's completely related. But the thing is, can you do the math? So with Ricardo's laws of rent, and I set up various variables, like what's the average wage in town for a job? What's the average rent for farming land? What is the yield of each field? Because they will be different, like moderately productive, and extremely productive yield per acre. And you can calculate what the rents will be. Because you have the productivity, aka cash flow, but you also have the alternative, and the alternative also impacts. Because you could just say, well, I don't want to rent the farm that has low yield because I could just work in town at Starbucks and make more money or make the same amount of money with a lot less risk and a lot less effort, aka return over volatility. So he could say, well, the Sharpe ratio is better if I just work at Starbucks. It's the same process of making decisions of how do you choose which trader to invest in. Like if you thought about that problem, you're an investor, you have $1 million of your life savings that you want to dedicate to a Forex trader, and you got 100 traders in front of you. What is it that you look for, and how do you make the determination of which investor you actually give the money to? Well, there's math. How much risk? What is the return? What are your personal goals? How much money are you already making in all your other investments? You see? So you could even apply Ricardo's laws of rents and say, oh, they're not yield, yield of corn per acre that creates the rent. You could say, well, it's money over volatility divided by a return, which gives you some sort of risk tolerance. And all of a sudden you're making the same logical mathematical processes to make decisions, whether it's investing into a Forex trader or which land. So for example, the land that has the highest yield will probably have the highest rent. The land with the lowest yield will probably have the lowest rent. But what if you end up making the same amount of money either way? You put up $1 million to make $1 million. You put up $10,000 to make $10,000. Your return might be the same. Right? All of a sudden you're like, oh, well, they're the same. I don't know. So anyways, it gets very interesting. I think it's unfortunate that most people on Earth don't understand the last 1,000 years of human expansion and human growth and human knowledge. We've lost 99.99% of humanity's progress, like the burning down of the Alexandria Library in Egypt. Like, what was that? 3,000 years ago. And it's gone. Knowledge, all the accumulation of knowledge from all over the world, all over the Middle East, right? It's just gone. Burned down one night. The bibliothèque, right? The library. The books, the knowledge. It was just gone. Thousands of years of human knowledge, gone. So anyways, we have the internet now, so we should know everything. Cool. All right, so risk off. Great. We knew it was plausible. Okay, we knew it was plausible. We have the right tools to say, well, we're pretty close to it happening. Right? Like, let me back out on a 30-minute chart. Like, right? Up, breach. You see? Breach. And then, check this out. You ready? Chickadee check. Okay, how about this? Let's do this. Let me change the logic here, or my explanation. Do you see how a breach of this channel is one massive sign of bearishness? It's actually, to say it differently, as I've taught you in other lessons, the slope changed. The rise over run changed from positive to negative, right? Y equals mx plus b, where m is equal to slope, and slope is equal to rise over run. Okay? So this point here, and this point here, m is equal to a negative number. M becomes negative, aka bearish. Okay? Cool. So what if you were already a bear? Then you were ready, willing, and able. And would you have these green boxes there? No. No, that's for bulls. So you would, if you were already a bear, your bias pivots would be bearish. So how would you start the day? Breach of the trend, lower low, lower high, right inside your sell zone at the London Open. Otherwise known as yesterday was a down day, Asia fade. Okay, anyone that's taken the training course knows that this is where the London boys pee in their khakis. Actually, that's a different story. That's stop hunting. Wrong story. The London boys, okay, everyone that's taken the training course knows the London boys walk in, and what are they holding in their hand? A cup of tea, and they look for their trade of the day. And they're like, oh, it's overvalued, sell. Now, based on past market conditions, we only expected a target of here. So it's been very bearish. So that could impact tomorrow, which means that you might think this is very, very bearish, so it will definitely fall, fall, fall. The other thing it means is, think of it this way. If you were drawing on the string of a bow from a bow and arrow, right? You pull the draw and you draw back. And the farther you pull, the more it wants to snap back, right? Imagine the velocity, not the price change, but the velocity, the short time frame that created the change in price. So let's say there's a difference between if it moved 100 pips in a day versus 100 pips in an hour. Okay? What happens is the faster the velocity, the more likely people are going to take profit. And if they take profit, it'll either do this or it'll do full on reverse because all the bears are out. So it's really kind of interesting. The velocity is fast here, so it doesn't necessarily mean sell or sell. It could just be over. So you need to do your proper analysis. But the point here, again, this is in my book, I say breakout, wait for the pullback, and sell the roll reversal. So it's in my book. It's in one of the training courses. I can't remember. There's so many training courses. But this is the classic second chance. Lucas Ufford says, how much, and I think you're talking about the Bibliothèque Alexandria. How much was copied and sent to other places? Well, I think the opposite had happened, and I think that's the problem. I think the knowledge was sent from a bunch of different places to the Bibliothèque Alexandria. And it was a repository of all of humanity, ancient humanity's knowledge. So it went from fragmented to consolidated, but of course the risk to anytime you consolidate is the risk of ruin, right? So you lose your diversification, so to speak. So now I think for a long time we had lost that knowledge. Another period is the dark period in Europe where there was just the dark ages, we just lost touch of humans' history. For example, for hundreds and hundreds and hundreds and hundreds and hundreds and hundreds of years, the Romans lived in England. And to keep the Scots out, they built a giant wall called Hadrian's Wall. I mean, they were there for hundreds and hundreds and hundreds of years. The Romans. And then, if you skip ahead into history, the English are walking around England and they see giant walls. And they see giant statues and they see giant pillars. Obviously, there was a civilization hundreds of years earlier. Nobody in England remembered the Romans. So clearly it was a race of giants that could build these epic pillars and build these epic, Can you imagine? The Romans lived there for hundreds of years. They built Bath, for crying out loud, right? Where you could go and sit in the bath or whatever. So, it was common knowledge for a while that it was built by a race of giants. So imagine just losing the knowledge. People just didn't know the people that lived with the Romans died or were assimilated, and then there just was no Roman Empire anymore. And so 300 years later, no one's educated, no one has a sense of the past. Maybe the religious, but they were so preoccupied with God that they didn't keep the history. So the history was just lost. Can you imagine that virtually nobody in England, maybe a couple of kings, but even then, who knows? Virtually nobody in England knew the Romans lived in England for hundreds and hundreds of years. It's just amazing what you could lose. What we lost in that fire, yeah, who knows what we lost? Some people are thinking like, clearly aliens participated in the building of the pyramids, and that knowledge was in the library. So we've lost touch, we've lost the maps, we've lost the communique from the alien beings that visited us and gave us amazing science, and then we've lost the science, and the aliens only show up every 5,000 years. Well, it's only been 3,000 years, so 2,000 years from now, the aliens will come back and say, "What's up, guys? What have you been doing with your time?" And they're like, "Sorry, we forgot. Sorry, I've been playing on my phone. We built Facebook! We built Facebook! We have computers that could do billions of tasks in a second, so we use the computers to do Facebook." The aliens are like, "What?" Yeah. So anyways, so I think it was just fragmented, and they tried to consolidate it in, of course, the most advanced society of all times. Imagine, like, I try to imagine things like, imagine you were Roman. You're the first Romans to show up in Egypt, and you see the pyramids. Holy smokes. Imagine you're in medieval Europe and you live on a farm somewhere in a dirt hut. And every once in a while you would make the day's journey by horse or by walking to the village, and they had a pub and a whorehouse, and the sheriff was there so he could collect your taxes, and that was that, right? And then you go to Paris. There's stone buildings that are 2 stories high, and then you walk into a cathedral, you walk into Notre Dame, and it's 8 stories high, and there's stained glass, and the organ comes on, and you're like, "Oh my God, music so loud, I'm shaking," and you're like, "There's a God for sure," right? It would have just been amazing. You may have never heard live music. Well, you only heard like people playing a flute or something, right? And all of a sudden you hear a choir, and you're listening to Bach, and you're in this giant building, and oh my God. Right? Or Colossus. Colossal means big. Well, Colossus built a tomb for himself that was bigger than anything else in the ancient world. And he had these doors that were like 40 feet tall that weighed like, 10 tons per door. Well, one person can't open the door, right? You can't push open a 10-ton door. And there's 2 doors made out of stone. But one of the first machines ever invented was a steam machine they put under the floor. So all of a sudden, the giant doors would open. And the priest would come out, and they're like, "How did the priest open the door?" "Well, it's the invisible hand of God." Meanwhile, they forgot to tell people, no, we built a steam engine. And you can't see it because it's under the ground, but we heat the thing up, and the steam is generated, and the steam comes out, and it pushes this thing that turns, and then we push it on an axle to another thing that turns, and that energy goes up to the thing, and it turns, and the doors are actually on weighted, and the beep, the steam engine in the basement actually opens the doors, not God. And you're like, whoa! But Colossal did that. And now colossal means big, right? So anyways, it's just very interesting. All right. So risk off, which we talked about Friday, Monday, Tuesday, and here we are Wednesday. So what should you be doing here? You should be figuring out what you want to do tomorrow based on what you see here. Are you a bull or a bear? And then you need to be cautious to say, are market conditions likely to change between now and tomorrow? And that's why I said, if you're pulling on the drawstring, it might, like the velocity here might actually produce the up, which you think is weird because you're like, well, wait, it was down. Yeah, it was down. I'm not interested in what was. So this is an interesting buy, obviously, and then this is an interesting buy, and 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 this is where it breaches and it's over for bulls. So does this mean it's going to do this? Yeah, I'd be ready, willing, and able to do that. Yes. Okay, that's the basic, simple analysis. Okay, that's not incorrect, but it is basic. I think we could say, well, this is an interesting cautionary tale. Okay, but also let's make sure we're analyzing this on the time frame, proper time frame. And by that I mean not day trades and stuff. Let's start by looking at this, and I don't even know what I'm looking at. Kiwi yen. Okay, fine. I'm just saying I'm not picking this on purpose. I'm just picking one. Okay, position trading. Let's say we're still bullish. Because right now we're trying to analyze if there are bulls in the market, will they threaten tomorrow's bearish trade? Okay, so let's take a look. Where are we? And we're still in the buy zone for the month. Doesn't mean you're a buyer, but it also means it's sort of too late to panic, right? If you had bought here or here or here or here or here, you've already been knocked out. So don't worry about it, okay? The next thing is maybe a buy emerges here in the next day or two. Oh, well, that'd be threatening to the bears. So it's not a bearish exit, but if bulls get back in, there will be a threat. Okay. This is just monthly, so we have to put that in. We don't know, on a monthly, this isn't an exit for bears, but it's still an entry for bulls. So now on a smaller time frame like weekly pivots, if this is an exit zone for bears and it's a monthly bull entry zone for bulls, then that can produce the counter trend, in particular with this velocity. Okay, cool. This doesn't tell bears to get out because we know bears would have looked at it differently, and this is an incredibly obvious sell zone for bears. So bears right now are thinking, oh yeah, this is going to drop another 200 pips or more, okay? So now we have to analyze it and say, well, what is the risk to that 200 pip drop here? Because now it would be like, okay, maybe it will drop another 200 pips, but there could be a very significant pullback. And so if you're getting in it now, you're assuming all the risk and with little meat on the bone, right? 3 other dogs have already chewed on this bone, okay? Okay, cool. So let's take it to the next level. Okay, is there a weekly threat to the bears? Let's take a look at that. What do you see here? Well, first of all, remember what I'm looking for. I'm not looking for bullishness. I'm looking for a threat to bears. And in this case, we already know on the long term, we're still in a bullish buy zone. So we already know that threat exists. We need to now change this to say, well, if I'm a bear and I want to add to this position, I need to know where the current bears would exit, the ones that sold at the top. Where would they exit? So I don't want to be in bullish mode. I want to be in bearish mode. I want to know where the older bears are going to exit. And I see that right now based on price, on pivot points, okay, that is $69. And if you want a zone, let's bring this back, open your biased pivots, scroll down to midpoint pivots true, and it'll give you the conservative target is 69.20, the aggressive target is 68.95. Okay, so I can adjust this if you want and say there's the aggressive, there's the conservative. So when you get here now, guys, think of it. We know this zone here is bullish, and we're worried about the velocity today, and we're worried about if we get down to here, weekly bears get out, monthly bulls get back in, and it's going to happen around this psych level of 69. So there is high potential, maybe even probability, of a full bore counter trend to counter the counter trend that we're in, which means we're neutral. Counter trend down to counter trend up, and nothing happened. Okay? And a drop below there is very, 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 very bearish. But it's not that bearish now. It was today, it was this week, but we're still in a very, very boring buy zone. If you were a longer term bull that traded this double bottom, as far as you're concerned, nothing's changed. You'll probably buy this. And that's what I'm saying. These buyers may have gotten knocked out here and are going to buy again here. And these sellers that sold here are going to exit here for profit. So these bears get out, these bulls get back in, and you got yourself an up. Thank you for your time today. Thank you for being here. Thank you for your professionalism. Thank you for your focus. Thank you for your discipline. If you want to watch the video over about, here, look, I can open it up.
It went down, up, down,
What do Forex investors look for in a good trader?
You might have had 20 trades in that, right? But the thing is, this whole period, you're ready, willing, and able. You can only sell, and you sell highs. You know how to sell. You can use pivot points, weekly pivot points, monthly pivot points, daily pivot points.
So I think we're pretty productive. We talked about lots of random things, but we also talked about risk-adjusted performance analysis. We talked about, we did a couple of yen pairs, but it's pretty obvious. We did a few dollar pairs. We looked at the indices and such. But I think we're just waiting now, really. So you got to be careful. I think we're waiting for Biden to win. Oh yeah, let's see it. We'll see what happens. So I bid you adieu. Thank you for being a subscriber. Please click the like button. It tells YouTube we're doing a good job. If you like the Forex.Today logo, maybe you want to get a bunny hug or a coffee mug in the store, because I'm hoping that tells, oh, there it is right there. I'm hoping it tells YouTube that this is quality content and they help us promote our community of Forex traders. So, yeah. What is the measure of volatility? Volatility is the measure of volatility. So think of it as in your returns, the lowest lows and your highest highs, okay? Or spend the next week searching YouTube for risk-adjusted analysis and find out the various measures of volatility. But remember, volatility is how often something changes. Low volatility would be 5% to 2%, 3%, 4%, 1%, 2%, 3%, 2%, 1%, 5%, 2%, 3%, versus 1, 5, 6, negative 33. All of a sudden, so think of it as the range. You can think of it as regression. How far from your average does your performance do? So again, I used this example, and maybe that it's going to be helpful. I said if you're okay, so like let's do this percentage return over time, and your results look like this. So there's 1%, 2%, 3%. And year 1, 2, 3, 4, whatever, or month 1, 2, 3, 4, and it looks like this. Well, I guess it would be slightly different. Hang on, let me redo this. It looked like this: 2%, 3%. Notice they're all positive numbers, right? What if it looked like this? Would it be fair for you to say, well, if you invest with me, you'll make 100% per year? Because in November, December, you doubled the account or whatever, right? And then you forgot to tell them, well, along the way you were negative 33, and then you're up to positive 18, and then you were down to negative 10, and then you got really lucky, especially because you used a lot of leverage at the end. You bet everything on one move and you hit it, so you went from negative 10 to plus 100. Well, they want to know how'd you get there, and if you just did a big bet to get a high return, but meanwhile you had all this, right? Because the investor won't know if they calculate here how much money we'll have, and then a month later, if you just waited a week, you blew out the account basically, right? And you're like, what? Negative 33, what the hell is that? Right? And then, oh, you earn it all back, and then boom, you're down negative 18. You're like, holy shiz. And then, oh, well, then you bet it all and you got here. And it just shows that you're not consistent. Okay? Someone wants to see that you do 3% every month. And if once in a while it's plus 1.5, and every once in a while it's plus 4.5, but this change is generally described by the change in general market conditions, not because your strategy failed or you did a poor job. Well, the market conditions change, so right? So your alpha matches your beta, and at the end of the year you average 3%, which means compounding over a year, you're going to make about 50% return. Minus, let's say, what the NASDAQ did. So now your alpha is that you performed, well, in this case, you performed more than 100% better than the NASDAQ, even adjusted or discounted for the opportunity cost of you could have just invested in the S&P, or in this case NASDAQ. You could have invested in NASDAQ and got 15, so you already had that money in your pocket. So above and beyond that, the Forex account produced 30, so therefore 30 on top of that, right? So you've doubled for the same amount of risk, ideally, depending on your volatility. So anyways. All right, so I will see you tomorrow. I gotta go. I gotta bump Jade. I gotta bump Jade. I gotta jump, bro. It was real. I will see you tomorrow. All right, thanks.